On June 10, 2023, at the New York Stock Exchange, a critical incident began to unfold, marking a pivotal moment in the modern digital economy. The main actors in this incident were a network of investment firms that operated on a suite of automated trading algorithms, relying heavily on a specific JavaScript library for processing market data in real time. This library, though widely integrated, was maintained by a small open-source community and had not received significant scrutiny for a considerable time. The first technical failures stem from a misconfiguration within the trading software that utilized this library. Specifically, an overlooked edge case in the code base allowed for erroneous interpretations of market signals during periods of high volatility. Key parameters that defined acceptable thresholds for initiating trades were set too loosely, allowing the system to misread sudden shifts in stock prices. This misconfiguration created an access vector whereby the automated trades could trigger not just a few, but thousands of simultaneous sell orders without any human oversight. As the trading day progressed, the initial measurable impact became evident. By 10:05 a.m., minute-by-minute trading reports indicated a dramatic spike in sell orders, reaching over 30,000 transactions within a span of just a few seconds. This flood of activity contributed to a flash crash in key stock indices. The Dow Jones Industrial Average plummeted by 800 points in under 10 minutes, wiping out approximately $1 trillion in market capitalization. Investors watching the screens in disbelief noted that several widely held stocks were suddenly trading at prices drastically below their previous valuations. The lack of historical precedent for such rapid market movements only deepened the confusion. Inside the affected firms, reactions were immediate yet chaotic. Internal emails flew back and forth as trading teams scrambled to assess the situation. An incident channel was quickly established, but responses were hampered by wide-ranging assumptions about the nature of the problem. Some teams suspected a network outage, while others theorized it was a failure within the data feeds that supplied market information. A handful of engineers initiated partial fixes based on what they presumed to be a benign glitch, unaware that the root cause lay in the JavaScript library's misconfiguration. Meanwhile, alerts from monitoring systems seemed to confirm their worries about system overloads instead of pinpointing the flaw in trading logic. Externally, clients began to voice their concerns as activity shifted to social media platforms. Users reporting unusual trading behavior flooded forums, and small financial news websites began picking up the story. The minor media mentions described an anomalous event affecting markets, but few grasped the scale of the issue unfolding. Financial analysts, caught off guard by the sudden shift, began speculating about a potential trading algorithm glitch. However, without definitive information, the narrative remained fragmented and speculative, leaving the general public uncertain about the gravity of the event. As the situation developed, the cascading effects of the initial misconfiguration became evident. Other trading platforms, interconnected through a web of agreements, found themselves beginning to experience disruptions as their trading conditions spiraled out of control. Subsequent waves of sell orders triggered automatic safety mechanisms known as circuit breakers, intended to halt trading during times of extreme volatility. These measures interrupted transactions but also contributed to further uncertainty in the markets. Hours passed with stocks continuing to plummet further, and investors grew increasingly anxious, unsure how deep the crisis would run. In response to the ongoing chaos, significant voices within the financial community convened emergency meetings to discuss risk mitigation strategies. Participants included regulators, financial institutions, and algorithm developers examining the situation closely. Some representatives expressed concern about the potential interpretation of the incident by external stakeholders, emphasizing the need for clear communication. Many trading firms, already beset by confusion, now faced external pressure from stakeholders who demanded explanations for the sudden upheaval. As these discussions unfolded, it became clear that long-term implications loomed on the horizon. Calls for enhanced governance over trading algorithms intensified, and proposals for regulatory oversight gained traction. Nonetheless, these conversations also revealed deeper insecurities regarding the financial infrastructure's dependency on automated systems and the inherent vulnerabilities posed by oversights like the one that had just led to a near collapse of market confidence. By the end of the day, uncertainty prevailed. Significant stocks had undergone unprecedented volatility, and a profound sense of fear gripped the financial community. As efforts to assess and mitigate the damage accelerated, discussions about the nature of automated trading systems, their governance, and the roles of human oversight began to reshape conversations across trading firms and regulatory agencies alike, setting the stage for an escalation that would reveal the fragility of the entire financial system. The ripple effects from the June 10th incident began infiltrating every corner of the market, and the digital landscape of finance was about to be redefined in ways no one could yet comprehend. As the following days unfolded, the fallout from the June 10th incident became increasingly pronounced. Multiple investment firms, tethered to the automated trading systems that had malfunctioned, reported substantial financial losses. Preliminary assessments revealed that over $1 trillion in market value had been wiped out across various sectors, with certain hedge funds experiencing losses exceeding 20% of their portfolios. Media coverage escalated, drawing in mainstream news outlets that highlighted the crisis. Headlines warned of a potential financial apocalypse, and analysts called for investigations into trading algorithms and their governance protocols. In the ensuing weeks, responses from institutions morphed from reactive to proactive. Within a week of the initial crash, several major trading firms publicly announced the suspension of algorithmic trading while they conducted internal audits. Some firms began notifying clients of the potential financial ramifications and legal implications of the upheaval. Simultaneously, stock exchanges implemented tighter controls and communication strategies to manage market expectations and discourage panic selling by retail investors. As data from the incident continued to surface, it revealed glaring oversights. Internal reports from affected firms indicated that the JavaScript library, which malfunctioned and caused the sell orders, had not undergone rigorous testing or review prior to its integration into trading systems. This failure to manage software updates effectively had created vulnerabilities that ultimately contributed to the crisis. Whistleblower disclosures from within some firms indicated that warnings about inadequate testing protocols had been previously ignored, a miscommunication compounded by a culture that prioritized rapid development over caution. With the public narrative shifting, regulatory bodies began to take action. The U.S. Securities and Exchange Commission, SEC, launched an investigation, issuing subpoenas to several firms for documentation regarding their algorithmic trading practices and risk management strategies. Public hearings were scheduled to assess the causes of the crash and to determine the need for regulatory reform. Legal actions from jittery investors soon followed, with class action lawsuits emerging against firms accused of negligence for their role in the crisis. As investigations progressed, the cryptocurrency market, which had been closely linked to traditional financial sectors, experienced a significant backlash. A multitude of trading platforms faced outages as demand surged and panic spread among crypto investors seeking refuge. Crypto exchanges implemented emergency measures, including withdrawal limits and trading halts, straining their infrastructure and further compounding financial losses. Over the months that followed, regulatory discussions began to bear fruit. In October 2023, the SEC proposed a series of new regulations aimed at improving transparency and oversight for algorithmic trading. This included mandatory testing standards for trading algorithms and an emphasis on risk management protocols that would require firms to have contingency plans in place to deal with rapid market fluctuations. In addition, firms were pressured to increase human oversight of automated systems, a move seen by many as a necessary shift in the industry. The consequences of the June incident extended well beyond the immediate financial realm. Several firms faced permanent reputational damage, leading to executive resignations and restructuring within their risk management teams. Particularly notable was the resignation of the CTO of one major hedge fund, citing the incident as a failure of the organization's governance. Amid worrisome public sentiment, some trading platforms experienced long-term user attrition as clients sought security in more traditional financial practices. By January 2024, the reverberations of the trading disaster remained felt throughout the industry. Some firms had opted for mergers or acquisitions to stabilize, while others were forced to file for bankruptcy, unable to survive the market upheaval. The infrastructure once complicating the trading landscape was now undergoing a systemic overhaul, emphasizing more stringent regulatory oversight. Ultimately, on March 1, 2024, regulatory bodies announced the implementation of the proposed reforms. These measures marked a significant shift in the landscape of automated trading, ensuring that market participants would be more accountable to both investors and the financial system at large. As of this date, many affected firms continued to navigate the aftermath of the crisis, grappling with the dual challenges of recovering market trust and implementing the new compliance requirements that sought to prevent such events in the future. The global financial ecosystem was irrevocably altered, reshaping strategies across investment firms.